The silver price keeps falling, and if you're only watching the COMEX chart, it looks like the market is getting weaker by the day. At first glance, it seems demand is fading and lower prices are inevitable, but that story begins to fall apart the moment you look beyond the Western markets. On the other side of the world, buyers in Shanghai are paying a substantial premium for the exact same metal. Not a few cents more, a meaningful premium that has continued even while COMEX prices slide lower. Pause and think about that for a moment. If silver were truly losing demand, if supply were plentiful, and if the market were genuinely weak, why would industrial buyers willingly pay more? Why would that premium continue instead of disappearing? Those two prices cannot both be telling the same story. One reflects what traders are doing with paper contracts, while the other reflects what real buyers are willing to pay for physical silver. That difference matters far more than most investors realize. Today on AgJohn Silver Update, we're going to break down exactly why this gap exists, what it reveals about the global silver market, and why experienced precious metals investors are watching it so closely. By the end of this video, you'll understand why many analysts believe the headline silver price isn't showing the full picture. Most investors in the West focus on the COMEX silver price because it serves as the global benchmark. Dealers, mining companies, and financial institutions all reference it. But it's important to understand what COMEX really is. It's primarily a futures exchange where the vast majority of contracts never result in actual silver changing hands. Instead, traders buy and sell paper contracts, speculating on price movements or managing financial risk. That doesn't mean COMEX is unimportant. It clearly influences the market, but its price is driven heavily by hedge funds, banks, institutional positioning, algorithmic trading, and technical signals. In the short term, those forces can move prices even when physical demand tells a very different story. Shanghai operates under a different model. Its precious metals exchanges are built around physical delivery. When buyers purchase silver, they're often taking ownership of real metal rather than simply trading financial contracts. The prices there reflect what manufacturers, refiners, and industrial users are actually willing to pay to secure physical supply. And right now, that physical market is sending a message that stands in sharp contrast to what COMEX is showing. Although prices in Shanghai and COMEX usually stay relatively close, small differences are completely normal. Currency exchange rates, transportation costs, taxes, and import fees can all create minor pricing gaps. But what we're seeing today is far from normal. The premium in Shanghai has remained unusually high for an extended period, even as COMEX silver prices continue to decline. That isn't the kind of imbalance you expect in a healthy, well-supplied market. Think about what that really means. Every time silver sells off in New York, buyers in China aren't backing away, they're often willing to pay even more to secure physical metal. Instead of narrowing, the price gap has been widening. If global demand were genuinely collapsing, both markets should be moving lower together. That's clearly not what's happening. Now, I'm not going to throw out an exact premium number because these prices change every trading session across different time zones. Anyone claiming an exact live figure without verification is doing you a disservice. What we do know is far more important. Throughout 2025 and into this year, multiple respected metals analysts and institutional reports have consistently documented Shanghai silver trading well above its normal premium. In several periods, buyers have paid more than $1 or even $2 per ounce above international pricing, far beyond what shipping costs or normal arbitrage could explain. That's not market noise. That's a powerful demand signal. So why is this happening? The biggest reason is China's enormous appetite for physical silver. The country dominates global solar panel production, manufacturing roughly 80% of the world's supply. Every solar panel depends on silver because it remains the best electrical conductor available for photovoltaic technology. And China isn't just exporting those panels, they're installing record-breaking amounts at home as part of an aggressive expansion of renewable energy infrastructure. But solar is only part of the story. Silver is also essential for electric vehicles, advanced electronics, artificial intelligence hardware, 5G networks, medical equipment, military technology, and countless industrial applications. As the world's largest manufacturing economy, China consumes vast quantities of physical silver every single day. When industrial demand continues to grow faster than available supply, buyers compete more aggressively for the metal. That's exactly what higher Shanghai prices are showing. Reports continue to indicate strong silver imports flowing into China, and the domestic market is absorbing that supply remarkably quickly. The premium exists because real manufacturers need real silver, not paper contracts. So if physical demand is clearly strong, why does COMEX sometimes tell the opposite story? The answer lies in how the futures market actually works. COMEX is heavily influenced by large commercial banks, institutional traders, hedge funds, and computer-driven algorithms. Many trading decisions are based on technical indicators rather than physical supply and demand. When silver falls below important chart levels, automated systems and momentum funds often trigger additional selling, creating sharp downward moves even if nothing has changed in the real physical market. This creates a cycle that's repeated many times over the years. Technical selling accelerates, hedge funds liquidate positions, prices fall further, and commercial traders often buy back their short positions at lower prices. In many cases, these moves have far more to do with futures market positioning than with the actual availability of physical silver. Once you understand the difference between these two markets, the divergence begins to make sense. Shanghai is pricing physical metal that industries urgently need. COMEX is pricing financial contracts influenced by leverage, speculation, and trading strategies. They're connected, but they're not measuring the same thing. And right now, those two systems are delivering completely different messages. At this point, the obvious question is, if silver is cheaper on COMEX and more expensive in Shanghai, why doesn't everyone simply buy it in New York, ship it to China, and pocket the difference? In theory, that's exactly how arbitrage is supposed to work. Price gaps should disappear quickly, but in the real world, the silver market has several obstacles that make that process far more complicated than it sounds. First, buying a futures contract isn't the same as taking delivery of physical silver. Getting actual bars out of COMEX warehouses involves procedures, waiting periods, and a limited pool of registered metal that's available for delivery. You can't simply click a button and have truckloads of silver shipped overnight. Second, transporting silver halfway around the world isn't cheap or fast. Shipping, insurance, customs clearance, and security all add cost and time. By the time the metal reaches its destination, market conditions may have already changed. China also tightly controls precious metal imports. Only approved companies with the proper licenses can bring large amounts of silver into the country. Add in China's capital controls and restrictions on moving money across borders, and suddenly, that easy profit becomes much harder to capture. Some arbitrage does happen, but not nearly fast enough to eliminate the premium. The fact that the premium continues despite these efforts tells us something important. Physical demand inside China remains strong enough to absorb incoming silver while still keeping prices elevated. That's a sign of sustained buying pressure, not temporary speculation. Now let's look at another piece of the puzzle that often gets overlooked: COMEX warehouse inventories. Every day, the CME Group publishes reports showing how much silver is stored inside approved vaults. That silver is divided into two categories: registered silver, which is available for delivery, and eligible silver, which is simply being stored but isn't currently committed for delivery. Over the past few years, one trend has become increasingly clear. Silver has steadily been leaving those vaults. There are occasional increases, but the broader direction has been lower. Physical metal is moving out of the Western system. Where is it going? Some of it is delivered to fulfill futures contracts. Some is withdrawn by private owners. But a significant amount has been flowing toward Asia, particularly China and India. India has also become one of the world's largest silver importers, driven by both industrial demand and investment buying. In other words, this isn't just a China story, it's an Eastern demand story. Here's why that's so interesting. While the paper price has been falling, the physical inventory supporting that market has also been shrinking. Normally, declining inventories support higher prices because they signal tighter supply. Yet the futures market has continued pushing prices lower, creating a growing disconnect between paper trading and physical fundamentals. This isn't happening in isolation either. For decades, New York and London controlled precious metals price discovery. Global markets simply accepted the prices established by COMEX and the LBMA, but that balance is gradually changing. China has spent years building its own commodity exchanges and strengthening its influence over global pricing. As the world's largest consumer of many industrial metals, it makes sense that China wants greater control over markets that directly affect its economy. The growing Shanghai premium reflects that shift. Through real buying activity, China is effectively saying physical silver is worth more than the paper market currently suggests. Similar patterns have appeared in gold during periods of exceptionally strong Chinese demand. At the same time, the broader fundamentals continue pointing toward tighter supply. According to the Silver Institute, the global silver market has experienced consecutive years of physical deficits, meaning total demand has exceeded mine production and recycled supply. Industrial consumption continues reaching new highs thanks to solar panels, electric vehicles, electronics, AI infrastructure, defense technologies, and medical applications. Mine supply simply hasn't kept pace. Since most silver is produced as a byproduct of mining copper, lead, zinc, and gold, increasing production isn't something miners can do overnight. That means the market has been filling the gap by drawing down above-ground inventories. Silver stored in ETFs, commercial vaults, and private stockpiles has been leaving storage to satisfy industrial demand. But those inventories are finite. Once silver is manufactured into electronics, solar panels, or other industrial products, much of it isn't immediately available to return to the market. When you combine persistent physical deficits, shrinking Western inventories, record industrial demand, and a growing premium in the world's largest physical silver market, you begin to see why so many experienced analysts are paying close attention. The daily COMEX price may dominate financial headlines, but it doesn't always tell the complete story. Sometimes the physical market quietly reveals what's really happening long before the price chart finally catches up.